Let's talk about a $5,000 investment that I just made. Now, this isn't the kind of investment that's going to double next week or even jump up 100% in the next month or two. That's why I'm calling this a get rich slow investment, and that is in Tyson Foods. I just bought $5,000 worth, about 77 shares, I think. So this is a behemoth of a company. I mean, they are servicing 20% of all the chicken, the beef, and the pork, roughly, in the United States. I think $43 billion in sales. So they're not doubling in size, but they're down right now. And I see a strong recovery coming in the next few years. And this is a big buy and hold type investment for me. So I'm going to break down just a brief overview of the company, what it's good at, what its strategies are, why it's down right now. Then we're going to go into how it's going to get out of this down point and what we see for the future. And then finally, I'm going to do a technical analysis, dig into the numbers as to why I think this is a very sound investment to hold for the long term. And then I'm going to do some price projections at the very end of this video. So jumping right in, just a brief overview. Like I said, Tyson Foods does 20% roughly of the poultry, beef, and chicken in the US. Chances are you've heard of them before. They're huge. I think they have 200 plants in the United States processing all of this meat, just so much meat. As someone who's done the carnivore diet in the past, that's a lot of meat. That is a lot of meat. $43 billion in revenue. They own all sorts of brands that you've heard of. Jimmy Dean, Sara Lee, Hillshire Farms, Go Meat, Adele's sausage. Those are some good sausages if you've ever had that. And about 35 other brands that you may or may not have heard of. Massive. Oh, and also they own Keystone Foods, which you might not have heard of, but they're the supplier for McDonald's chicken nuggets. So there's kind of a play on McDonald's as well, if we think about it. So they're down right now. They are down because of COVID. They had to close facilities because workers were getting sick. The problem with these plants is they've spent literally decades trying to get as many people into these plants as possible, consolidating, closing down old, less efficient plants and just putting them in these big mega plants. So we got all these people and these things and meat all in one area. The perfect storm for something like COVID to come along, and then a few workers get sick, they get other workers sick, and this shut down, I think, 24 or so of their plants in the last year, and this has caused meat shortages. It has increased expenses. Of course, their stock has seen a pretty drastic decrease because of this. Overall, they're down because of it. Another reason they're down is because of restaurants. Restaurants are still closed all over the country, and 31% of Tyson's sales go to restaurants. Now, they've absorbed some of this because people still need to eat. People are just eating a lot. And this restaurant food has just transitioned to home food. So they've had to shuffle around some of their branding and things like that. It's caused some supply chain issues, but they've absorbed some of that restaurant downage, but not completely. And 31% of their sales is a huge amount. Another reason they're down is there's a combination of lower output because of these closures, and the demand is a little bit lower because of restaurants, but also costs have increased a little bit, at least temporarily, because of COVID safety measures. All these 200 plants that they have, they're adding all these safety measures to try and make sure that workers are not getting sick. This is jumping up expenditures, at least in the short run, while sales are down. And then finally, their net income has fallen by about 15% this year, which, given all things, isn't horrible, but that's another reason why the stock price has gone down. Now, Tyson's strategy in the past has had a heavy focus on roll-ups, buying other companies, buying other brands, and just adding to their brand and keeping that efficiency high. So, they'll buy another brand. If they have a small, inefficient plant, they'll close down that plant and move it to one of their super, ultra efficient plants and, continue the sales and grow the sales. And that's generally their strategy over the last 70 or so years, is just acquisition after acquisition, growing, and they plan to do so in the future. They're also seeing more and more sales to China. I saw that year over year, their meat sales to China have increased 600% year over year in the recent past. So that's a huge reason that we may see an upswing in the future. And we also see them focusing more recently on non-meat options, which I was really glad to see this when I was doing my research into this company, because one of my major thoughts was we're seeing more and more people gravitating to this non-factory farming, less meat, things like that. So I'm glad to see that Tyson realizes this and they're focusing on other brands. And they actually even had a huge investment in Beyond Meat, but they sold that in 2019. And they have a few other brands like a chickenless chicken nugget brand. I'm just glad to see that they're open to these options and they're not being hard-headed about, nope, we're only meat. No, they understand that people are going to eat. These things might change. So they're, putting investment into those things. However, still where it sits, the market size for these non-meat options is a fraction compared to the meat options as of right now. Maybe that'll change even more once the non-meat options, become more prevalent and get a little bit better, but I'm just glad to see that they have some focus on that. And before we move on, I wanted to thank the sponsor of this video, Society Socks. They are fans of the channel and they wanted to sponsor some of my videos. So I said, send me some socks and then we'll talk. So they did, and I'm blown away. They sent me like 10 pairs. Here's a few that I have yet to wear because I wanted to keep these, nice labels on. They're high quality. They're kind of quirky. It's kind of fun. And there's also a discount code where if you use code Maher with the link in my description, you'll get $10 off any purchase of $20 or more, or off any new subscription service. So support me by supporting Society Socks. Now, I would consider Tyson Foods to be a recovery play. That's because restaurants are closed right now. We know that's 31% of their sales. Many restaurants are closed anyways. And we also know that once this is all over, this will eventually be over, people are going to go back to restaurants, maybe more than they ever did, because people want to go out and do these things and be served and, have this experience that they haven't been able to have for the last year and a half, maybe 2 years at that point. And when that happens, Tyson Foods will be there with their 200 plants to service all these restaurants and get that food out there. And we're going to see a big upswing. And also as COVID quells and settles down, we're going to see fewer and fewer infections, and that's going to drive their costs down per location with all these COVID screenings and the technologies that they've had to implement in order to make sure their workers aren't getting sick. And like I said, they're just poised for this huge upswing. I mean, they're massive. They're one of the biggest food producers in the entire world, and they are poised for this recovery. And this is one of the few stocks that are still down despite the entire stock market rising. And it just doesn't make total sense because looking at their numbers, the numbers are good. I mean, we're going to go over this in a second, but the numbers, I think there's people missing out on this opportunity. And that's why I've made a pretty significant investment into it. And if it stays around where it's at, I will very likely increase my investment because I see this doing quite well in the long term. So now that we have an idea of what the company does and what we might see in the future, whether that be a year down the road or a few years down the road, this is a long-term buy. Let's get into the fundamentals, get into the math as to why I think that this is a good investment. And, you can think of every reason in the world whether to buy or to not buy a company just based on how markets are doing, how you feel about that industry. But I like to really answer these questions by looking at the numbers and letting the numbers tell me whether it's a good investment or not. I know it's not as exciting, but I think it's the better way to do it. So I have this stock screener spreadsheet that I use to determine the health of companies and if they have a competitive advantage. So the first thing that I'm looking at, the price to earnings ratio. So with Tyson, we have a stock price currently of $65.25. We have an earnings per share of 601. So that's a ratio of just over 10. We're almost at 11. And that's pretty darn good. I'm looking for a ratio between 4 and 15. So we're right in the middle there. And like I have written here, you can think of this as the number of years it'll take to return 100%. 10 is quite good. Next, we have the price to book ratio. So we take the stock price divided by the book value per share. We get 1.53. We're looking for a price to book between 0.6 and 1.5. So we're a little bit over that. Now, this spreadsheet is based on ideal scenarios. So we're likely not going to hit every single one, but I'm looking to hit as many as possible. And if you look at the entire stock market, there's very few that even get close to hitting all of these. And that's how I know, if it's a good investment or not. Next, we have debt to equity. So we take total liabilities divided by shareholder equity. We get 1.22. On this, we're looking for around 1, just generally, but this varies industry to industry. So you want to compare this to other players. And we're looking pretty good with that. This basically tells us how leveraged the business is. Current ratio, You just take current assets divided by current liabilities. With this one, we're looking over 1.5 and we got 1.86, so we're pretty darn good here. And this is another good one to compare to industry ratios and the other big players, and we're also looking pretty good there. Market cap, $19 billion. I look for anything over $100 million. 100 million is pretty small, but that's where you can see some big gains. Obviously, this is a pretty huge company, $19 billion. And then dividend yield, I look for anything between 2 and 7%. They are at 2.78% historically. So we hit all the initial markers there. So once we hit those, then I move on to the next step, and that's to determine if this company has a competitive advantage or not. So again, we're wanting to hit as many of these as possible. We don't have to hit every single one, but the more, the better. So we got gross margin, taking gross profit divided by total revenue, and we get 13.96%, which is pretty darn good industry-wise and pretty darn good considering that this is an industry where prices are pretty fixed. You know, people tell if prices increase a little bit with meat, and they're pretty sensitive to price increases, so it's hard to have good profit margins. So we really have to be good at the efficiency of operations to get these up, and it's a good sign that 13.96 is their gross margin. Now their net profit isn't the best ever. We'll go over that a little bit later, but again, for the industry, it's really not bad. Next, we have selling, general, and administrative to profit. So we got 2.17 billion to gross profit, 6.03 billion, ratio of 35, almost 36%. With this one, we're really looking for it to be consistent year to year. So these administrative costs, the sales costs are staying consistent, but you want to see sales increasing, which we are seeing, and they were pretty darn consistent with Tyson. Next, we have depreciation to profit. We're looking at 17.7% here. We want this low. 17.7% is okay given the fact that they have huge operations and 200 facilities and a lot of assets. So 17.7%, like I have written here. Coca-Cola is 7%. But they're kind of like a gold standard company. And Coca-Cola isn't nearly as cheap as this is, relative. So 17.7%, I didn't let that keep me from investing, but that could be a little bit lower if we're being completely honest about this investment. Next, we have receivables to sales. So we take our net receivables divided by total revenue, we get 4.51%. And then with this one, you want to compare this to industry averages. So we have JBS, which is a huge meat producer, and they're at 6.6%. And we're actually lower than them, which is a great sign. Oh, and also going back up to the gross margin, JBS is 8.8%, and we are at 13.96%. So again, a great comparison there. Next, we have return on assets. This is basically the management's ability to earn profit and revenue on the assets that they have. Over 5% is considered good. So we got a net income divided by total assets, 34.74 billion, and we got 6.16%, which is of course over 5%. We're good to go on that one. Next, we have return on equity, which as you can see here is the management's ability to generate income from the equity available, and 15 to 20% are generally considered good. So we take net income divided by shareholder equity, and we got 13.6%, which is close to that window. Again, we're just trying to hit as many of these as possible. And then finally, we have a few more things that I like to look at just to further my decision. What's the company's average interest expense? 3.8%. We want this as low as possible. The lower, the better for a competitive advantage. Net earnings. This is where we wish this was a little bit higher. We're at 5% net income to revenue. And then we have earnings per share. We want to see this growing consistently upwards. With Tyson, it's increasing, but not in a straight line. We can take a look at their earnings per share here on Market Watch. Earnings per share basic here. So we can see, it's increasing, jumps up, and then goes back down, increasing. So there's an upward trend. But there's a little bit up and downs, but generally it's going upwards, so I consider that good. Cash on hand. So high amount of cash, it means two things. It either means the company has a competitive advantage, or they're selling off a business or bonds or things like that. And this company has a lot of cash on hand, and it doesn't appear that they're selling off a ton of assets. Inventory. Now we're looking for an increase of inventory and an increase of net earnings at the same time. It means the company is finding more profitable ways to increase sales, and we're seeing that. Yes, we can check that box. Goodwill, If goodwill is increasing, it means that they're buying other companies with competitive advantages, and we're seeing an increase in goodwill. Additional stock purchases. Now, it's good if we see no preferred stock, which we don't with Tyson, and it's also good if we see purchases of treasury stock. And we also see that with Tyson. Purchases of treasury stock means the company is buying back its own shares, which basically tells us the company is confident in itself, so much so that it thinks that it is a good investment to buy its own shares. So that's a really important indicator that they're confident in themselves. And then finally, investments and debt. So we want to see our net earnings be able to pay all of our debt off within 3 to 4 years. That isn't exactly the case with Tyson. We're looking at about 9 years, which isn't ideal. But again, this is a company that is very asset heavy. So it's, that's one of those toss-up kind of things. Is this worth investing? Is it not? I decided, yes, it is. Oh, and also, if you're at all interested in investing and you don't know where to start, check out the link in my description for Webull, where you can receive 2 completely free stocks with a $100 deposit. I've mentioned this a ton of times on my channel because it is an amazing deal and a great way to just get into investing. You can get a couple free stocks, you can watch them, see how it goes before you actually dive in and make any investments. Check out the link in my description for that. Now, like I said, for me, this is a get rich slow kind of investment. I don't expect this to double next week, next month, even next year. I actually purchased at about, I think, $68 a share, and then it dropped down to $64 a share. I lost like 7-8% in the first couple days. And what I ended up doing, because I was confident in this, I just doubled my position to help mitigate those very short-term losses. And if we stay right around $64-ish a share, I will keep purchasing at this price, most likely, as long as there's nothing else that comes out about this company that is detrimental, which I don't see that. I see long-term this to be a pretty good play. My price target for this company within the next 2 or so years is $100.80, which would mean an increase of 50 to 55% in the next 2 years, and then I see stable growth after that. Bottom line is this company isn't going anywhere, and the stock price, given everything that I can find, seems to be lower than it should be compared to the industry, compared to the market as a whole. It just seems like a good investment, so that's why I made my purchase of this. Now, I will say that I am not a financial advisor, so do your own research on this. This is just a single investment that I made, and I hope you find this helpful. Again, if you appreciated this, please click the like button and subscribe, and hit that notification bell too, so you're notified of all my updates, both on finance and news and business. I'd just like to thank you for watching, and I hope you have a profitable day.